Ladies and gentlemen, let me start with a simple question. What if the biggest signals in the global economy aren't shouted, but quietly bought? While headlines argue, debates rage, and analysts hesitate, the smart money moves in silence. And today we're here to talk about one of the loudest, silent moves the market has ever seen. JPMorgan quietly accumulating 47 million ounces of silver. This is not noise. This is not speculation. This is strategy. 100 silver isn't a prediction. JPMorgan's 47M ounce buy proves it's happening. This isn't about hype. It's about behavior. In economics, what institutions do matters far more than what they say. Banks don't gamble. They position. And when one of the most powerful financial institutions on the planet commits to silver at this scale, it's not guessing the future. It's preparing for it. Think about this carefully. 47 million ounces is not a hedge. It's not a trade. It's a declaration. JPMorgan understands something fundamental. Silver is no longer just a metal. It's a strategic asset. It sits at the intersection of monetary instability, industrial demand, green energy, and technological growth. From solar panels to electric vehicles, from medical applications to defense systems, silver is becoming essential. Demand is rising. Supply is tightening. That is not opinion, that is economics. Now let's talk about the number everyone's obsessed with, 100 silver. This isn't a crystal ball forecast pulled from thin air. It's a mathematical consequence of pressure building in the system. Inflation erodes purchasing power. Currencies weaken. Debt expands. And historically, when trust in paper declines, value flows back to tangible assets. Silver has been suppressed, overlooked, and underpriced for decades. The question is not if it revalues, but how violently when it does. Here's the uncomfortable truth. By the time silver hits 100, it will feel obvious. And when something feels obvious, it's already too late. Opportunity doesn't knock when everyone's watching. It whispers when most people aren't listening. JPMorgan is listening. They're not waiting for permission. They're not asking for consensus. They're positioning before the crowd wakes up. That's how wealth has always moved, quietly, early, and decisively. This moment isn't just about silver. It's about awareness. It's about understanding how power, capital, and foresight operate in the real world. Markets reward preparation, not panic. And while I'm not here to tell you what to buy, I am here to challenge how you think. Watch actions, not headlines. Follow accumulation, not commentary. Learn to recognize the difference between prediction and proof. In economics, markets are best understood not through headlines or opinions, but through behavior, especially the behavior of institutions with the deepest access to data, risk models, and long-term capital. When an entity like JPMorgan accumulates 47 million ounces of silver, it is not reacting emotionally to price fluctuations or media narratives. It is executing a calculated decision rooted in macroeconomic analysis, balance sheet protection, and forward-looking expectations. Banks of this scale do not chase trends. They anticipate structural shifts long before they become visible to the public. Consider the scale of this action. 47 million ounces is not a tactical trade designed for short-term profit. It represents a commitment of capital that assumes future conditions will justify holding a non-yielding physical asset over alternatives such as bonds, equities, or currencies. That choice alone raises a powerful question. What does an institution with unparalleled insight see coming that makes silver more attractive than traditional financial instruments? In economics, capital allocation is the purest form of belief, and this allocation speaks with extraordinary clarity. Institutional behavior matters because large financial players operate under constraints that retail investors do not. Regulatory oversight, stress testing, liquidity requirements, and reputational risk force banks to act conservatively. Every major position must survive layers of scrutiny and scenario analysis. When such an institution commits to a physical commodity, it signals expectations of volatility, monetary instability, or structural imbalance that cannot be easily hedged through paper instruments alone. This is not a bet on price movement. It is a hedge against systemic risk. History reinforces this pattern. Before inflation becomes visible in consumer prices, institutions reposition. Before currency weakness becomes obvious, capital quietly migrates. The public debates possibilities, institutions prepare for outcomes. Silver, in this context, becomes less a commodity and more a form of insurance, one that protects purchasing power when confidence in financial systems erodes. That transition is subtle, but it is decisive. The most important insight is this: markets move not when consensus forms, but when positioning is complete. By the time institutional actions become widely discussed, the strategic advantage has already been claimed. JPMorgan's silver accumulation is not meant to convince anyone. It doesn't need to. Its purpose is to be ready. In economics, readiness precedes recognition, and those who understand behavior over narrative recognize the signal long before the price reflects it. Silver occupies a rare and increasingly powerful position in the global economy because it operates simultaneously as a monetary asset and an industrial necessity. Very few commodities can claim this dual identity, and even fewer are as deeply embedded in both financial psychology and modern production systems. This alone should command attention. When an asset is demanded not only for wealth preservation, but also for economic function, price dynamics change fundamentally. Silver is no longer optional, it is essential. From an industrial perspective, silver's unique physical properties make it difficult, and in many cases impossible, to replace. It is the most conductive metal for electricity and heat, which places it at the core of technological progress. Solar panels rely on silver paste to convert sunlight into usable energy. Electric vehicles require silver in power electronics, batteries, and charging infrastructure. Advanced medical equipment, water purification systems, and high-end electronics all depend on silver's reliability and efficiency. As economies push toward electrification and decarbonization, demand for silver rises not by preference, but by necessity. Now consider the other side of the equation, monetary demand. For thousands of years, silver has functioned as a store of value and medium of exchange. In periods of monetary expansion, rising debt, and declining trust in fiat currencies, silver reasserts this role. Unlike digital assets or complex financial products, silver carries no counterparty risk. It does not depend on policy decisions, interest rates, or institutional solvency. Its value exists outside the financial system, which is precisely why it becomes more attractive when that system shows stress. Here is where the hook becomes unavoidable. Industrial demand consumes silver permanently. Unlike gold, much of the silver used in technology is not economically recoverable. It is dispersed, lost, or destroyed in the production cycle. This means that rising industrial use does not just increase demand, it reduces available supply. At the same time, monetary demand remains cyclical but powerful, surging precisely when economic uncertainty peaks. These two forces do not compete, they compound. The result is a tightening market structure that traditional pricing models struggle to capture. Investors often view silver through a single lens, either as a commodity or as money. In reality, it is both at once, pulling demand from two different economic worlds. When industrial growth accelerates and monetary confidence weakens simultaneously, silver is placed under pressure from both sides. That pressure does not announce itself loudly, but it builds relentlessly, reshaping the market long before the price reflects the imbalance. Silver supply dynamics reveal one of the most underestimated vulnerabilities in the modern commodities market. While demand narratives often dominate public discussion, supply is where pricing power is ultimately determined, and silver's supply structure is far more fragile than most assume. The global market is not facing a temporary shortfall, but a persistent structural constraint that quietly tightens with each passing year. This is the kind of imbalance that does not resolve itself smoothly. It builds pressure beneath the surface. A critical issue lies in the nature of silver mining itself. The majority of silver is not mined as a primary resource, but is produced as a byproduct of mining for metals such as copper, lead, and zinc. This means silver supply is largely dependent on the economics of entirely different markets. Even when silver prices rise, production cannot easily respond, because miners are not incentivized to increase output unless base metal demand justifies it. In economic terms, silver supply is highly inelastic, and inelastic supply is a catalyst for sharp price adjustments when demand increases. Compounding this challenge is the decline in new discoveries and the long development timelines required to bring new mines into production. From exploration to permitting to full-scale operation, the process can take over a decade, often longer due to environmental regulation, political risk, and capital constraints. This creates a lag that financial markets routinely underestimate. By the time shortages become visible, the supply response is already years away. That delay is not a flaw in the system, it is a structural reality. Another often overlooked factor is the quality of existing ore. Many of the world's largest silver deposits are experiencing declining grades, meaning more material must be processed to extract the same amount of metal. This raises production costs and increases vulnerability to energy prices, labor shortages, and regulatory pressure. Higher costs do not guarantee higher output. They frequently result in constrained production or mine closures during periods of economic stress. The hook is simple, but powerful demand can surge overnight, but supply cannot. When industrial consumption grows, investment demand rises, and stockpiles are drawn down, the market has very few mechanisms to respond quickly. Structural deficits are not theoretical, they are cumulative. Each year of undersupply reduces above-ground availability, tightening the system further. In economics, such conditions rarely lead to stability. They lead to moments where price must do the work that supply cannot, and when that happens, the adjustment is rarely gradual. Modern economic history shows a clear and repeatable pattern. When inflation accelerates and currencies lose purchasing power, capital does not disappear, it relocates. Inflation is not merely rising prices, it is the silent taxation of savings. As governments expand money supply to manage debt and stabilize growth, the real value of currency declines. This erosion rarely feels dramatic at first, but over time it reshapes behavior across households, corporations, and institutions. The hook is simple yet unsettling. People do not flee currencies when they collapse, they flee when they quietly disappoint. Currency debasement is not an accident of policy, it is often a consequence of necessity. High sovereign debt levels limit policy options, making monetary expansion the least painful short-term solution. Lower interest rates, quantitative easing, and fiscal stimulus inject liquidity into the system, but they also dilute currency value. Traditional savings vehicles struggle to keep pace, and fixed income instruments lose their protective role. In this environment, the logic of capital preservation changes. The question shifts from how much return can I earn to how much value can I keep. This is where real assets re-enter the economic conversation. Unlike financial assets, real assets cannot be created by policy decision. They are finite, tangible, and exist outside the balance sheets of central banks. Silver, in particular, becomes attractive not because it generates income, but because it resists dilution. It does not promise yield, it preserves purchasing power. That distinction matters more in inflationary environments than in periods of stability. Historically, this rotation is subtle before it becomes visible. Capital moves incrementally at first, often led by institutions seeking diversification from currency exposure. The public typically follows later, after inflation becomes embedded in daily life. By that stage, prices have already adjusted. The early signal is not panic buying, it is quiet reallocation. When confidence in fiat weakens, even slightly, demand for assets with intrinsic value strengthens disproportionately. The hook lies in timing. Inflation does not need to be extreme to change behavior, it only needs to be persistent. Even modest, sustained inflation compounds into meaningful loss over time. As currencies weaken gradually, real assets gain relevance not as speculative instruments, but as financial anchors. Silver's role in this rotation is reinforced by its affordability relative to other hard assets and its independence from financial intermediaries. In economics, trust is the true currency, and when trust in paper declines, value inevitably migrates toward what cannot be printed, diluted, or redefined. Extended periods of suppressed pricing create distortions that markets cannot sustain indefinitely. In silver's case, years of heavy reliance on paper contracts, derivatives, and leveraged instruments have disconnected price discovery from physical availability. On paper, supply appears abundant. In reality, physical inventories are far more constrained. This gap between financial representation and material reality introduces revaluation risk, a condition where price remains artificially contained until pressure forces a sudden adjustment. The hook is uncomfortable but critical. Markets can ignore reality longer than expected, but they cannot ignore it forever. Price suppression often persists because it benefits stability in the short term. Volatile precious metal prices can signal currency weakness and undermine confidence in monetary policy, so controlled pricing becomes a convenient outcome. However, suppression does not eliminate demand, it redirects it. As prices remain low relative to fundamentals, industrial users increase consumption, investors accumulate quietly, and above-ground stockpiles shrink. Each ounce delivered into long-term storage or industrial use reduces available liquidity in the physical market, tightening the system without attracting public attention. The risk emerges when physical demand begins to overwhelm paper supply. Futures markets rely on the assumption that most contracts will be settled financially rather than with delivery. That assumption holds only as long as confidence remains intact. When participants increasingly demand physical settlement, the The system is forced to reconcile contractual promises with finite material. This is where suppressed markets tend to break, not gradually, but abruptly. Price must rise to ration demand and restore equilibrium. History offers clear parallels. Commodities subjected to long-term price control often experience sharper pricing once constraints fail. These moves are rarely linear. They occur in spikes, driven by urgency rather than optimism. Silver's relatively small market size magnifies this effect. Compared to equities or sovereign bonds, silver requires far less capital inflow to generate significant price movement. This makes it particularly sensitive to shifts in investor behavior once revaluation begins. The hook lies in asymmetry. Suppressed prices limit downside risk while amplifying upside potential. When an asset trades below its fundamental value for an extended period, the cost of maintaining that imbalance accumulates. Revaluation does not require widespread participation, only a tipping point where physical scarcity becomes undeniable. At that moment, price stops reflecting sentiment and starts reflecting necessity. In economics, this is where markets move fastest, because price is no longer negotiating, it is catching up. In economics, outcomes are often mistaken for predictions, especially when numbers capture public imagination. The idea of 100 silver is frequently dismissed as speculative because it is framed as a forecast rather than what it truly represents, a potential equilibrium response to cumulative macroeconomic forces. Prices do not rise simply because people believe they should. They rise because existing prices fail to balance supply, demand, and confidence. When that imbalance persists, adjustment becomes unavoidable. The hook is this: markets do not move to surprise participants, they move to restore function. A price level such as 100 is not arbitrary when viewed through structural analysis. It reflects the possibility that silver must reprice significantly to ration limited supply, attract new production, and absorb competing forms of demand. Industrial users require continuity of access, investors seek preservation of purchasing power, and institutions demand protection from systemic risk. If current prices cannot satisfy all three simultaneously, price must rise until equilibrium is restored. This is not optimism, it is economic logic. Institutional accumulation plays a critical role in this process because it signals expectations of future constraints rather than short-term gains. Large entities do not base positioning on headline-driven targets. They evaluate stress scenarios, currency risk, and long-duration trends. When institutions accumulate silver, they are not betting on a specific number. They are preparing for a range of outcomes in which silver's current valuation fails to reflect its strategic importance. The number becomes a byproduct, not a goal. The hook deepens when time is introduced. Markets can tolerate imbalance temporarily, but prolonged mispricing compounds pressure. Each year of supply deficit, monetary expansion, and rising industrial reliance pushes the system further from equilibrium. At some point, gradual adjustment becomes insufficient. Price must move decisively to reset behavior. This is why major repricing events often feel sudden, even though their causes have been building for years. The critical distinction is understanding that outcomes emerge from constraints, not consensus. By the time 100 silver appears plausible to the majority, the economic forces that justify it will already be in place. Institutions recognize this dynamic and act accordingly, not to predict the future, but to remain solvent within it. In economics, the most powerful signals are not bold declarations or dramatic forecasts. They are quiet reallocations made before the adjustment becomes visible, when the outcome is already forming beneath the surface. So remember this: 100 silver isn't a dream. It isn't hype. It isn't a prediction shouted on social media. It's the logical outcome of forces already in motion, forces that the world's largest institutions are quietly aligning with today. History doesn't announce itself in advance. It leaves clues. And right now, silver is one of the clearest clues we have. The only real question left is this: will you notice it before the rest of the world does? Thank you.